Is tapping into the equity you have in your home a good source of money for financial goals? Keep listening to find out. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you had learned in medical school. I'm your host, Dr. Jimmy Turner, and here is our co-host who is currently reverse searing a couple of steaks on the smoker, Justin Harvey.
Dr. Turner, pleasure to be here as always.
It's a pleasure to hear from you because I have no idea what reverse searing steaks I don't even know how to say that. What is that process?
So imagine sort of option A is the normal sear, which is basically like trying to land a jet fighter on an aircraft carrier in a stormy sea, versus having essentially like an infinite runway to land your plane, which is a much more straightforward and difficult to screw up situation. A normal sear is you get your hot surface, your grill, whatever type of thing you're cooking on, up to a very high temp. You slap your steak on either side until you're targeting that internal temp of somewhere between 115 and 145 degrees. But you got to know how long to have it, how long to flip it, or when to flip it, and then the thickness of the steak changes. Obviously, the algorithm, which is for someone of my relatively rudimentary culinary capabilities, it's a little bit difficult. So the reverse sear is you get your steak up to the desired internal temp by doing a low, slow. I've got it in the Traeger out back, so I got it at 185 degrees while we're chit-chatting here, and I might run out after this episode just to make sure nothing crazy is happening. But you achieve within 5 degrees of the internal temp that is ultimately desired before you sear it. And then you pull it off and you slap it for a few seconds on the cast iron to get the crisp on the outer parts that you want, and then voila, it's ready to go. So
when am I coming over for dinner?
Dude, we got to make that happen.
I actually love smoking meat too, and hilariously, I was talking to Bradley Block, who's another podcaster, physician, ENT doc, and we actually did an episode on his podcast specifically on smoking meat. So if you'd like to hear that, go check out Bradley's podcast. On this show, though, we're not going to talk about smoking meat. We're going to talk about HELOCs, home equity, and I found this to be a really interesting topic, in part because Kristen and I, we don't currently have a HELOC, and in researching for the show, talking to you, Justin, it made me realize that we probably should. So if you are interested in learning more about that and why you should consider having a HELOC too, this is going to be a really good show. And even if you don't, it'll be good for you to learn about it. But before we dive in, I just want to tell you, like, it's really not uncommon that we have docs reach out to ask us about disability insurance after they finish training, only to find out that they don't have options because they, didn't get disability in training. They may have, type 1 diabetes or cancer diagnosis, or maybe they have an orthopedic procedure they've had done that kind of prevents them from getting insurance that they could have gotten when they were in training. And the reason why is because when you finish training, the guaranteed standard issue policy no longer exists. And so as we get into April, May, and June, particularly for those of you that are finishing training, I just want to mention that you need to make sure you check this box to get own occupation disability insurance so that if you do need the GSI, which is what I should have gotten since I have a medical history, you can obtain that while you're in training because it goes away after you finish training. So if you're looking to get quotes for that, you can go to moneymeetsmedicine.com/disability and we can get you some own occupation disability insurance quotes for you. So Justin, I actually learned, you want to know the dumbest thing that I learned? And I'm saying dumb. There are going to be people that don't know this too, so I shouldn't say dumb. But I felt a little silly not knowing this. But there's actually like two different kinds of things when we're talking about this, right? So there's a home equity loan, and then there's a home equity line of credit. And apparently those are not the same thing. And so as I was digging into this, I didn't realize that little nuance there. And it actually makes a lot of sense, right? So that home equity loan, right, is like, you know exactly how much you need to borrow. The bank says, great, you've got equity in your house. Here's this lump sum of money that you now have taken out. And now you do owe interest back. You got to pay it back. For us, it's a little bit like let's just say a second mortgage. Whereas a HELOC is like a potential place to tap into. It is a line of credit like a credit card, except for it's based on the equity you have in your house. And so you don't ever have to touch it. It's just there. It's available should you need it, when you need it, if you need it. But unlike the home equity loan, which is it's money given to you that you owe back, the home equity line of credit is something that people can tap into. And so I don't know that it made me realize that I don't know as much about this topic as I thought I did before starting to research because I'm like, wow, I'm like starting to get like point A, the basics, and like I didn't know these were two different things. So I'm just gonna admit that publicly because I feel like it's good to have some humility on the show.
Yes. Yeah, that's an important distinction. And a loan versus a line. A loan is a fully formed concrete thing with a term and an interest rate and an amount that is discrete. It can't be changed, or at least without costs and penalties associated. And the line is a it's revolving credit, so you can use it or not use it. It can sit there and not cost you anything, or you can ramp it up whenever you're ready to take it off the shelf. Which is why I'm a big fan of the home equity line as a bit of financial flexibility, a gift to your future self, if you will.
Yeah, yeah, and that's actually what kind of preempted this concept for the show, which was that we did the show on emergency fund. If you missed that, you should go check it out. And one of the things you mentioned on that show was a HELOC as like a secondary backup, like layer two an emergency fund plan. And when you said that, I was like, you know what? That's actually a really good idea. And you also know what? Like Kristen and I don't have one. And so it really made me kind of think about like, hey, I need to go learn more about this. We need to educate the audience. I need to educate myself. And so, I found that to be actually really true when I started looking into this. So let's just, make it a little concrete. Right. Let's say that you have a $500,000 house, and this might actually be a reasonable example given the market over the last 3 or 4 years. Let's say you bought a house 3 or 4 or 5 years ago for $500,000. That house is now, become, worth $600,000. And let's say that, you also paid off $50,000 from that original loan that you had, right? So you've got $50,000 you've paid off of, the principal. You've got the $100,000 that it has appreciated. And so now you have $150,000 in equity in this house. And so because it's at least 15 to 20%, the bank would say, "Hey, yeah, we can give you this line of credit, this 150 grand that you can tap into should you need it. Here are the terms if you decide to ever borrow the money and like actually take it out, which we'll talk about in a minute." But it provides you, I don't know, the way I basically thought about this, Justin, to be honest with you, is like a credit card from your house. Like your house is lending you a credit card at half the interest that a credit card would have. And so, that is that kind of the right way to frame this, or am I completely off there?
I mean, as much as credit cards are kind of a dirty word in some circles, I would agree with you. And for the same reason that I actually don't mind having $100,000 of credit card capacity for the same reasons, like it doesn't cost you anything to be able to run up 100 grand on your Amex if, God forbid, some kind of, real crisis happened. It's good to be able to access that capital. Uh, the home equity line is less onerous in its terms because a credit card it could be 29%, and a home equity line is prime plus a margin. Right now, it's probably like 8 to 10% in the current interest rate environment, which is a third probably. So far desirable. Personally, I like to see a little more margin, a little more equity than the instance that you described, because a bank is not going to give you up to 100% LTV, loan to value, and it's only going to give you LTV from appraised value. So it's one thing for you to say my house is now worth 600 grand because look at what Zillow told me. It's another thing when the bank appraiser drives by and then they look at a bunch of comps that you don't think are really comps, but it is what it is. And banks are still around because banks are conservative and they don't like to take any kind of risk or think creatively or interestingly
Sure.
at all.
Right.
So they have to agree and assess that your house is in fact worth 600 grand. But if they did, they may only give you up to 80, 85, or 90% LTV. So if they, for our hypothetical example, if the bank said, okay, Jimmy, we think your house is worth 600 grand, you have 450 that you owe, we're going to give you up to 90% LTV. Now I'm going to do math on the fly in my head, which I hate to do,
15.
but
15.
540 grand would be the max borrowing capacity if you could
Right.
access up to 9. If the bank says we'll give you 90%, 540 is the total indebtedness you could carry. And so
Right.
if you owe 450, you can owe 540. There's a $90,000 margin there, home equity line potential that you would qualify for, that you could then sort of have accessible to you to use at some future determined date.
Yeah, and I think it's important to discuss the credit card versus HELOC conversation, and the reason why is because a credit card, as much as it would be just terrible, right, to rack up six figures in credit card debt, the impact of that if you don't pay it off is on your credit score, and the impact of not paying your HELOC off is you lose your home. And so there is a different thing that's at collateral with those two different situations. And so, I do want to say that up front because there are some appropriate uses of a HELOC, like as a backup emergency fund. This is not your primary emergency fund. This is you have your 3 to 6 months saved. Maybe your next step is your brokerage account. Maybe not. Maybe it is the HELOC, but it is a secondary potential for an emergency fund that, God forbid, like it really, really hits the fan and like you need something, and it is there if you need it, but it is an emergency. This is not to save for a wedding, right? Or to buy a car, or to, do something that you could have short-term savings goals for in order to purchase. Because it does have some.
Yeah. Yeah, I don't hate those ideas as much as some of the, writers on marketwatch.com or wherever. But I would 100% agree and reinforce this principle that I'm talking about HELOCs or credit cards in this context for the person, the household that is fundamentally financially healthy. And what are the ways that we can continue to strategize, to position, to make your finances as durable and resilient as possible when life throws a curveball your way? I'm not talking about how to like triage, we're financially bleeding out. What should we consider? That's not what we're doing here.
But it's really important because, when you start talking about this concept, one of the things people are naturally going to think of, right? So we've talked before on the show that 25% of attending physicians have revolving credit card debt. And so you're like, wait, hold on, hold on. So if I have equity in my home, I can tap into that. And then they're like, but I've got this, $50,000 in credit card debt. And it's like, right, okay. So if you got the credit card debt because you have a spending problem, right? And now you're going to put it on a HELOC and now your home is at risk. That is not, in my opinion, a good use of that money. You got to fix the root of the problem, which is a spending problem, right? And so, like, I just don't want people to have this idea that, like, oh, this is like sweet, this is equity in my house, and I can tap into the whatever I want. One thing that I will say that I came across time and time again, and people may be aware of this because of the Tax Jobs and Cuts Act, that I think that's what it was called, right? That
Mhm.
happened during Trump's presidency. Before 2018 and basically after 2025, when that goes away, the home equity lines of credit, from your main home or a second home, actually, the interest you paid from that, basically, not regardless of your use, but for a wide variety of use, personal living expenses, credit cards, you could deduct that interest as an itemized deduction on your taxes. Because of the Tax Jobs and Cuts Act, that changed things. So from 2018 until 2025, when it goes away, for that 7-year period, one of the only things that you can deduct the interest from is if you improve the home itself. And so if you took money out through a HELOC and then you made a massive improvement in the kitchen, or you added another room to your house, the interest on that would be deductible in terms of an itemized deduction as you pay that down. I mentioned that because if you can increase the value of your home, some people would do this as a way to use a HELOC. Um, High income earning physicians, I don't know that maybe that's as applicable, because you can actually just save up money and then do the house renovation when have the money saved. So I'm not justifying using that, but it was interesting to me, no pun intended, that the interest was an itemizable deduction, specifically if it was used for home improvements.
Yeah, notably, this is only if you're gonna itemize and not take the standard deduction. For a family, if you're married, I think it's like 27 or 28 grand. For most of our listeners, if you own a home and you are paying, especially if you're in a jurisdiction with state income taxes, state and local taxes, 10,000, and your mortgage interest, especially in the front end of an amortization schedule, about 5/6 of the principal and interest payment goes to interest and not principal, or I should say goes to non-principal. So there's a lot of like expense that basically goes to the bank and the insurance company that moves you towards that $27,000 threshold. So a lot of people, if you are a
You
homeowner
have a
and make
pretty
a lot
big
of
pay
money, you're
every
going to
year.
be itemizing.
Yep.
Yeah.
And well, and so for us, it's like, yeah, it's a SALT tax, a state and local tax, a 10 grand there. It's the
Yeah.
the interest on our home that puts us almost right at it every year. And then after that, any charitable giving, right, becomes immediately
Yes,
itemizable. And so for us,
that's right.
because of our tithing for church, because of the other things that we give to, because of our SALT tax and our mortgage, yeah, we're not really at the point. But I do look forward to, tangential comment, by the way. This is not what the show's about, but I think it's a really cool concept. I do look forward to the point where our mortgage interest is low enough that we can then, just kind of front load a say charitable giving through a DAF in a single year, and then take from that to tithe in the years following. And so we take that, and then during those, let's say years 2 through 5, we take that big itemizable deduction year 1, and then 2 through 5 we take the standard, even though we're giving the same amount of money to the things that we believe in. I really, really look forward to that. But we're not there yet. Our mortgage interest is still high enough to get us to that standard deduction most years.
That's some next level stuff right there, Jimmy. Batching your gifting is definitely an advanced strategy that it's fun to kind of set those goals, especially around generosity that you can move towards over time.
Yeah, I'm all about it. Maybe we'll maybe we'll do another show where we explain that a little further, because a lot of people are driving their car right now and they're like, I don't understand what he just said.
Yeah, donor advised funds are, you've probably talked about them in the past, but that would be fun fodder for a future conversation.
Yeah, let's do it. All right, so we talked about what a HELOC is versus a home equity line. We've talked about maybe some good uses, maybe some questionable uses. Another questionable use, by the way, and I have to mention this like out loud to myself, is high risk endeavors like entrepreneurial pursuits, right? So like, because I constantly have people approaching me like, hey, Jimmy, I've got this idea. I know you've got business experience. I would love to talk to you about it. I actually had a conversation this weekend about such a business. And yeah, so don't use it for risky stuff is all I'll say. So you might be asking, hey, look, Justin, Jimmy, like this idea sounds great. I do want this as like a secondary backup emergency fund situation. How do I go about getting it? You mentioned the equity, like the LTV and kind of the limit that they'll place. Basically like the minimum criteria is 15 to 20% equity in your house. Like if you don't have at least that much, it's kind of a non-starter. You have to have a good debt to income ratio. So if you're carrying around, $200,000 of credit card debt and your income's $200,000, it's probably not going to work out too well for you. And then good credit score, which by their definitions is like somewhere like 600, 650, 700, give or take. And then a verifiable income. I mentioned this last one is super important, because if you're going to use this as a backup emergency fund, you need to employ it before you have a financial emergency and no longer have a verifiable income. If you're like, oh, I'm just going to do this right when things get bad, it's like, actually, they are not going to now give you a line of credit that they don't think that you can pay on. And so if this is something you're considering, I would encourage you to do it sooner rather than later. And
yeah, I on that note, I have a number of different sort of presentations that I built over the years for the physician crowd, and one of them is like all the things to do before you quit your job or before you finish residency or fellowship. One of them is like get a mortgage or a line of credit, because if you have a W-2, and this is really only true in cases where you're going to either move towards launching a practice or a 1099 independent contractor type arrangement where or even like a production model where you don't have a guaranteed base. Because banks, like I said, they're boring, they're not creative, they like to have everything in black and white and have very little downside. And if you have a W-2, they deem that to be as more stable than if you're making, even if it's a very high amount of money, 1099. So 1099 would be you're essentially a business owner, and you, in many cases, have to be in the same arrangement and showing a proven track record for 2 years or more before a bank is going to give you credit for earning that robust income, even if it is robust. So it's hard to get a HELOC if you are an independent contractor, even if you're out there making the big locums dollars right now.
That's right. Yeah, it's got to be reliable, verifiable, continual. Lots of consistency. And for people that have bought a house, I mean, you've seen that, right? Like, I mean, they it's like you said, it's the same kind of process. You're looking at the same people that are doing that. I, you know, if you're listening to the show, you might also say like, okay, great, this HELOC sounds really interesting, but like, why not just do like a more traditional refinance? Because most people listening to the show have heard of like people refinancing their home, and that was actually really, really common. 4 or 5 years ago, maybe even as recently as 3 years ago. I know that we refinanced our house, and I'm about to give like anxiety to a bunch of people that haven't just bought a house in the last like year or two, but we refinanced down to 3%. And so we were able to do that. We didn't take out any equity at that time. We could have, but we didn't. And so, at that point, when the interest rates were so low, people were like, oh, well, I had 4, 5, 6, and now I can, refinance down to 2.5 or 3. And so I'm going to do that. They may have taken out cash when they did that. And then as interest rates rose, and interestingly, if you'd locked in a HELOC back during that time, by the way, that'd have been money. If you haven't, the HELOC now is like you mentioned, kind of 7 to 9%, it's prime plus. And if you look back historically, it's been higher in the past. But with these rising interest rates, people are now looking at this and saying, hey, I was going to refinance my house to take out money to improve my property. Let's say this is the reason that you're using it. And now they're like, wait, but I have a 3% interest rate. I don't want to refinance, take out equity, and then take a 8% interest on my home and have my, my monthly, mortgage go up, and like the cost that that's going to assume, and, restarting on the interest. And so now people are saying, I'd rather take a HELOC, knowing that I may or may not tap into it at these higher interest rates that aren't credit card levels, they're a third. And so that's why over the last couple of years it's become more popular. In fact, I think that when I was looking at the numbers, 2023 compared to 2021, there was a 50% increase in utilization of HELOCs. And the biggest driver behind that was for home improvement projects that people had previously, and the 10 years before that, been cash out refinancing to pay for home improvement projects. So I found that pretty interesting.
That makes a lot of sense based on what I've seen. And I was a homeowner back in Pennsylvania. Now I'm a renter in the Pacific Northwest, and I have been watching the market just run away from me for the last few years, and that's fine. I love renting because I don't have to, the roof leaks, the whatever. I gotta swap out the deadbolts on the front door, just call the landlord, and that's all well and good. One thing to note. The interest rate generally for the products that I've seen, the HELOC, even if you locked it in or if you set up a HELOC 2 or 3 or 4 years ago, the rate will still continue to reflect market rates. So if you set it up back when you were looking at a 2.75 for a 15-year, which I have some clients that we did refis back then for starting with a 2, that's kind of crazy. It's like below the long-term inflation threshold. If they set up a HELOC back then, it's probably still 8% today if it has been unused, just because the rate does float over time.
So it's variable. It's when you borrow the money, like when you take it out.
Yeah, I think every month it resets, actually. With most of the products that I've seen, you'd obviously have to check with the lender, but that's what you should expect, is that whatever rates are doing today is going to impact the rate of your home equity line.
That makes sense. So when are some situations, from like a financial advisory perspective, that you've seen people, employ a HELOC or, really get behind this idea?
Yeah, well, I like to use it. I think about one of the ways I help clients sort of stress test their circumstances. Is thinking about, like, what is the worst case thing that could happen, and what is the number? What is the number that is so big that you're pretty sure you would have to really sort of dig into? We'd be cutting into muscle at some point. Like, how do we stress test to that regard? And so, okay, how much cash do you have? What do your brokerage accounts look like that you can access without meaningful, tax problems? Maybe your Roth IRAs, maybe your 401k loan, home equity, credit cards. Like, we kind of run down that hierarchy. And the home equity line is just another line item that we can kind of slot in there as something that is in the cataclysmic event. One of the tools that we can employ that I like, because it doesn't really cost you anything other than sometimes like a setup or appraisal fee. That's a one-time fee to have it as part of your armor, essentially. That's probably the most common utilization, is just one of the tools that we keep for a rainy day. Some personal experience that I've had with the home equity line was with launching a business. So, you talked about one of the things you shouldn't do. I did this, and I don't recommend that anyone else do this, just as a disclaimer, but I was at a place, I was young, single Justin. This is before I met my now wife, Sarah. And I owned a house. I had renovated the house in Philly, and I was living pretty lean. And, I had some cash saved up. I wanted to start this investment management firm back then. And I was interested in, I wasn't sure, wasn't sure how much I was going to need or how long it was going to take to have some revenue and then have some profit. And so I diversified my risk by having a couple jobs. We talked about wedding DJing. That was one of those side gigs back then.
I remember.
And doing a little bit of adjunct professorship at my alma mater, which pays a pittance, by the way, was hardly worth it, but a fun thing to do nonetheless. And then having a line of credit that I could access because of the renovations I had done on my home, it appraised at way more than what I had bought it for. And so for me, it was very much like, I can sleep well at night knowing that if it does take me 3 years to make money, or if I did, the wedding DJing scene dried up or whatever, that I was going to be okay, because I could access this capital to put food on the table for myself. It served a strategic benefit for me in that time. And frankly, I didn't actually end up using it, and it was more a psychological, it was like a security blanket for me, knowing that I can access another I think it was like 60 grand back then, if I needed it. It gave me a lot of confidence to do the thing that I ultimately ended up being, very successful at, which is I'm really grateful to have been able to take that step. So that it served an important function in my life in that regard.
Well, and I don't. What was the year that you did that? You remember around the time period?
2016, 17, yeah.
Yeah, and so like when you think about now where like the rates are 7 to 9%, right? From like and looking at this chart here, for the YouTube viewers, I'll pop this chart up here. But from 2010 until about 2017, I mean the rates were below 4%. Right. So if you told me like, hey, I'm going to take out this money and I'm going to, use this even for a higher risk business idea at 2%, to be honest with you, would say you're not crazy. Like that is not, in my opinion, a terrible financial idea. Like, could you come up with better ways to potentially do that? Yes, you could. That said, at 9%, definitely have some heartburn, at this kind of level, and knowing that it's variable, it could go higher, could go lower. So, maybe that's why right now in this current market, people are like, don't do that. Like that's probably a terrible idea. But back when it was 2%, and particularly back before 2018, when you could deduct the interest basically for anything that you used it on. And if you're listening to the show after 2025, if the Tax Jobs and Cuts Act didn't get renewed, you can deduct it again on lots of things, not just home improvement projects. So yeah, I mean, it's not like it's the craziest thing I've ever heard, right? But I do like the idea a lot, and the reason why I wanted to talk about this on the show is as the security blanket that you just mentioned, right? That emergency fund, that backup. It is there if you need it, and it's particularly appealing to me because of what happened with my disability insurance, right? So like if I lose my income, like my family to this day is in like a world of catastrophic financial hurt potentially because I don't have disability insurance. I can't get it. An insurance agent, hosed me when I was a fourth year med student. And so I've had to get creative about how do I make a disability insurance kind of feeling for my family, which is, potentially having a larger emergency fund, a larger brokerage account. Like we don't do the backdoor Roth IRA. Like I've talked about that on the show. I've tried to diversify my income in terms of where it comes from, and so I've done a whole host of things, but one of the levers that I hadn't pulled in my specific situation, I'm not telling you skip disability insurance and get a HELOC, just to be clear, but in my specific situation, like having that security blanket that you just described, like I think that would actually be extremely beneficial for my wife and for me. And so this is something we're going to pursue, which is why I really wanted to discuss this idea.
I think it makes a lot of sense. And I had a number of clients that it's like, oh yeah, for the $500 appraisal fee, I can add $100,000 to my emergency fund and it doesn't cost me anything ongoing. Like that's a pretty good deal. And if you don't use it, again, there's you got to look at the specific product and the specific lender and read the fine print, because sometimes, if you don't use it for 5 years, it'll terminate, or there's different provisions and things that are lender specific, institution specific. So make sure that you sort of stress test it, understand if there's any hidden fees or anything. But this is I think a really useful tool that I'm a big fan of in general.
Yeah, me too. So as we close out the show, just remember April, May, June, it's that time of year where people start checking this box to get own occupation disability insurance. Really, really important, in particular for those listeners that are finishing training. Please make sure you check this box before you go. One of those boxes that Justin alluded to a minute ago. But you can go to moneymeetsmedicine.com/disability. We can get you quotes from all of the 5 big carriers that provide own occupation disability insurance, and or look over your policy if that's something that you're wanting someone to do as well. Justin, you and I will see everybody next week. Cheers.
Can't wait. Thanks, Jimmy.
Justin Harvey is a certified financial planner at APM Wealth, where he helps physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest, North Carolina. He is also a licensed insurance agent. However, neither Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on this show and do not represent the views or opinions of their employer.